Thank you for watching this video. Today we will be doing technical analysis on the S&P 500 for the week ending Friday, October 8th, 2021. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. My name is Rodney Constable. I have over 30 years of investing experience, including over 25 years of experience trading stocks and options. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the developer and president of Simple Market Signals at simplemarketsignals.com. We will come back to this chart in just a couple of minutes, but I want to start with a weekly candlestick chart of the S&P 500 to get a big picture view of what happened for the week. So each candlestick on this chart does represent 1 week of trading, and this chart goes back to September of 2020. So we have a little over 1 year of data here. First off, the simple moving averages. The green one is the 10-week moving average. The orange one is the 20-week moving average, and the blue line right here, that is the 40-week moving average. You can see all of that annotated right there. The S&P 500 was up 79 basis points for the week, and we closed at 4391.34, and we did close above the 20-week moving average, as you can see right here where my cursor is moving, where last week we had closed just below the 20-week moving average for the first time in almost a year. It was last October, as you can see here in the lower left-hand corner where my cursor is circling. That was the last time we had closed below the 20-week moving average. And, of course, we had a little bit of trading below the 20 a couple of weeks ago and also this week. So the last 3 weeks we have traded below the 20-week moving average, but at least this week we successfully closed back above it after barely closing below the 20-week moving average the previous week. The next chart that we're going to look at is an hourly candlestick chart of the S&P 500 that starts at the beginning of July. Now, the reason I'm going clear back here is I want you to understand that we started off at around the 43.05 level the first trading day of July, and that is this lower blue line here. Now, this will come into play not only in this chart, but the next few charts, so it's super important that you understand the importance of this line. And you can see that we've only had a little bit of trading going clear back to the 1st of July. You can see there's only been a few hours of trading below this level, including this past week, okay? But we'll talk about that more over the next few minutes. Now, the next level is important, this 43.50, but really the more important lines are the 44.30 and 44.40 support levels, and that'll make sense as we go through the next few charts. But you can see we got up to the 44.30 level at the tail end of July. That then acted as overhead resistance. We got rejected and then finally got above the 44.30 level on August 6th. We kind of sideways for a few days there and kind of got trapped between the 44.40 and 44.30 levels, and then pulled back and then finally got a nice run. And that took us to the all-time intraday high, what is right now the all-time intraday high on the S&P 500, which happened on September 2nd at 4545.85, and that's right here. Now, from there, that started the sell-off, and you can see the sell-off then over the next couple of weeks pulled us right back to, and we stopped almost exactly on that 43.05 level. And then we ricocheted right back up, got above the 44.40 level a couple of weeks ago, finished the week there, and then rolled back over and came back down once again to this 43.05 level. Now, we slightly undercut the previous lows right here, right? So what happened is that then set up a double bottom, a short-term double bottom on the hourly charts right there and right there. And that pushed us up here. All right, so that started. We have multiple patterns that are kind of leading into each other. So I want you to kind of understand this. But unless you understand the 43.05 level and the importance, some of this, and also the 44.30 and 44.30 and 44.40 levels, some of this won't make any sense. All right, so just bear with me here. And so you can see that short-term double bottom as we zoom in here, right, and shorten up this chart. So it's the same basic chart. We're just starting this one on the 16th of September and kind of zeroing in on this area. But you can see on the 20th of September, and then the 1st of October, here's that double bottom. Well, that double bottom didn't hold, and that, we undercut within the next few days. We undercut that level, right? So that double bottom didn't hold. But what that did, you can see that established a head and shoulders reversal pattern on the hourly charts, right? So you can see there, and there. But it's easier when you take a look at it this way, all right? So now we have a left shoulder, the LS, left shoulder, the head, and the right shoulder. And that is an inverted head and shoulders reversal pattern as seen on the hourly chart of the S&P 500. And here's that neckline to that inverted, right, upside down. It's like you're standing on your head, but you can see the left shoulder, the head, and the right shoulder. That is a really nice head and shoulders reversal pattern. Okay, an inverted head and shoulders. But look at what happened, guys. It ricocheted us right back up to the 4430 level, right? So we stopped basically dead on Thursday, right? The highs on Thursday on the wick of that candle. You can see it right there when my cursor's moving, the arrow, the line, right at that 4430 level. So isn't that interesting, right? When we go back here again, you can see it, right? Stopped right there. So we have several things going on here. Again, that double bottom that kind of set up this head and shoulders reversal pattern right here, and that took us right back up to this 4430 level. All right. We've got to watch this 4430 level. I mean, the good thing is, at least in the short term, we've put in a bottoming pattern on the S&P 500 that shot us right back up to that overhead resistance level of 4430. And again, we can see how long this has been in play, right? This 4430 level has been in play since the latter part of July. So a super important level. Now, if we can get back up above it next week, that'll be great. But for now, it is acting as overhead resistance. So, the other thing that this did then, when you take a look at this chart, and again, we're still on an hourly chart, but the other thing that I'm seeing in these hourly charts is lower highs, okay? So a series of lower highs as the market bottoms and then tries to rebound. We're getting these lower highs and also lower lows, okay? So you can see here again the all-time intraday high that we put in at 45.85 on 9/2 right there. And then we had this bounce, got up to this high here, had another bounce, got up to this high here, and of course that stopped us at 44.30. So in the short term, we have this inverted head and shoulders reversal pattern, but we are also seeing a series of lower highs as the market is trying to bounce and is continuing to fail. So the question for next week, will we roll back over and make another lower low, and then possibly over the next week or two make another lower high and continue this pattern going lower? That is completely within the realm of possibility. Or, the market could get back above this 4430 and 4440 level and start, after about a little over a month of correction here. It's completely possible that the market can get back above this overhead resistance level that has been in play for several months and continue to try to move on to some higher ground. But there's no way to know at this point, guys, which way we're going to go. So caution is advised. Just understand we're kind of at an inflection point here, and the market from a technical standpoint could go either way. All right. Now, another thing that I want to share with you that I think is super important, it's going to be very important for a lot of you, is what's been going on with high-quality bonds. Now, we're just going to look at the performance numbers here, but even if you don't do a lot of bond investing, guys, this is super important, so stay with me, all right, because this is important for you to understand. Now, what we're looking at is the one-week performance of 3 different ETFs that track treasuries, high-quality bonds, right? These are treasuries, the 3 to 7 year, the 7 to 10 year, and the 20-year plus treasury ETFs, all right? So here's the ticker symbols. Here's the 1 week performance, all right? Now you can see here that, let's just start off at the 7 to 10 year. This is really probably one of the most important and one of the most popular ETFs. And generally, if you're in a 60-40, 70-30 type asset allocation, you would use high quality bonds like the 7 to 10 year ETF here to offset your equity risk, right? That's kind of a traditional long held investment portfolio. But I want you to understand that, guys, it's really not working very well anymore. And just this week alone, and we're going to take a look at a couple of different time frames, so bear with me here, but you can see just this week alone, the 7 to 10 year Treasury ETF fell 1.02%. The 3 to 7 year, the shorter duration, fell 54 basis points, and the longer duration, the TLT, fell 2.39% just this week. All right, and keep in mind the S&P 500 was only up 79 basis points. All right, so and the previous week the S&P 500 was down. Well, if we back this up another month, you can see what has happened. The 7 to 10 year is down 2.01%. You've got a 1.02% loss on the shorter duration 3 to 7 year Treasury ETF, and the 20 year plus is down 3.97%. So, guys, things just are not the same as they used to be. All right, and we're going to have to think differently if we're going to win. Right? If we're not just going to have mediocre results, we're going to have to think differently about investing on a go-forward basis because of the setup that is there in the markets. Okay, so super important for you to think about that. But just think about the fact that we've had high-quality bonds selling off even as equities have sold off, and there is the potential for that continuing on a go-forward basis. Now let me share with you a few things you need to be thinking about. First off, the stock market and the economy are not the same thing, okay? The stock market and the economy are not the same thing. We've got high-quality bonds selling off with equities as of late, all right? So we've seen, stocks selling off, and at the same time, you've got high-quality bonds selling off with equities. That is not a good thing. So what this means is that asset allocation won't work like it used to, okay? It can't. The math just doesn't work. So a 60-40 or 70-30 type portfolio, which a lot of people have, will likely underperform going forward with anemic upside and losses to the downside. So going forward, guys, equities and cash may be a better option for many, if not most, investors. However, you will need a market-based system to help you toggle back and forth between equities and cash. Even if bond prices stabilize, high-quality bond yields are extremely low. So what this means is that bonds at these yields represent a return-free risk. Now, think about this, guys. Get your head wrapped around this because this is so important. And this isn't just my opinion. I've seen guys that are billionaires that run huge bond funds and bond hedge funds and own investment companies that predominantly invest and trade in bonds. And these are billionaires that have made a lot of their money in the bond world, and they are saying the same thing. Bonds represent a return-free risk at these yields. Okay, at this time, bonds represent a return-free risk. So make sure you get your head wrapped around that. So as I pointed out a few seconds ago, going forward, equities and cash may be a better option for many, if not most, investors. You will want to increase your equities when risk versus reward is favorable for equities, and then increase cash when market risk rises and the risk versus reward is less favorable for equities. Okay? But to do this, you will need a market-based system to keep you informed of stock market risk. It's not going to work if you try to use economic data, news headlines, politics, gut feelings, hunches, guesswork, personal opinions, forecasts, or predictions, regardless of where those forecasts or predictions come from, okay? You cannot use economic data to manage money this way, guys. It just doesn't work, all right? You're going to need a market-based system to keep you informed of stock market risk. The only thing that really matters, and this is true regardless of whether you want to employ a strategy like this or not, guys, but the only thing that really matters is the stock market. Everything else is a distraction. Most people have a hard time getting their head wrapped around that. But these are the facts, guys. The only thing that really matters when investing in the stock market is the stock market itself. Everything else is a distraction. The stock market and the economy are not the same thing. Okay, so please remember that. The stock market and the economy are not the same thing. We don't invest in the economy. You can't buy shares of the economy. You buy shares of publicly traded companies or indices like the S&P 500. Now, obviously, we can't invest directly in an index. We have to go through an ETF or a mutual fund to get exposure to the index, but you get the point, right? That's what we're truly investing in, right? Is publicly traded companies, either one at a time, individual stocks, or using an ETF or a mutual fund, we're getting exposure to a basket of stocks or an index like the S&P 500. So going forward, to have a chance of success as an investor, you will need to focus on stock market-driven data. Future investing success will require getting in sync and staying in sync with the stock market by using stock market-driven data. Let me repeat that. Future investing success will require getting in sync and staying in sync with the stock market by using stock market-driven data. Now let's talk about some of the benefits of approaching investing in this manner. If done properly, some of the benefits of investing in this way will be increased upside capture, decreased downside capture, improved risk-return profile, and the ability to sidestep major market downturns. So think about this, guys. What if you could increase your upside, decrease your downside, improve your risk-return profile, and have the ability to sidestep major market downturns? What could this do for you, right, on a go-forward basis? What could this mean in your life if you were able to do these things? If you would like to learn how you can get in sync and stay in sync with the stock market, go to the description box below this video and click on the link, How to Stay in Sync with the Stock Market, and watch this video, okay? So again, that's in the description box below the video you are currently watching. Go into that description box and click on the link, How to Stay in Sync with the Stock Market. Watch this video, and it will explain how you can get in sync and stay in sync with the stock market on a go-forward basis.